Okay. Accounts receivable, the allowance account or accounts receivable using the balance sheet and the income statement. So let's begin with some data. So we have data. Accounts receivable balance at the beginning of the year is $300,000. So I have an accounts receivable of $300,000 and an allowance account normally has a credit balance, and it has a balance of $25,000. I have sales of $1.5 million, and I have an estimated of 2% of sales. Okay, so I'm using the income statement approach. I have write-offs during the year of $16,000. Okay, so the first thing I do, I post my collections. I collected $1,450,000. Okay, so let's post my data into my T accounts. I have sales. Okay, collected. I have bad debt write-offs. So bad debt write-off is going to be debiting the allowance account. Sorry, that's $16,000. Debiting the allowance account and crediting the accounts receivable. Okay, so we're just moving it. No effect on income when we actually write off our bad debts. So let's see what our sales, we have $1.5 million and 2% is the estimated, so we need to post an estimate of $30,000. So the percentage of sales of bad debt is $30,000. So under the income statement method, I just put $30,000 in. And at the end of the reporting period, my balance is whatever it is, $25,000 minus 16 plus 30, I'm at $39,000. So under the income statement approach, I just add it to the allowance account, and I come up with whatever balance I have. Different than what we saw in the previous video when we had a credit and debit balance in the allowance account, and we were estimating it based on the accounts receivable. So what would the accounts receivable? So if I do an accounts receivable, I would use 10% for the credit losses. Okay, so let's see what this balance is right now. 300 plus minus, I have 334,000 as a balance. If I used accounts receivable of 10% of the total balance, not aging it or anything, I can just use the total amount, okay? I would end up with 33,400. And that would be my allowance account on the balance sheet. That's why they call it the balance sheet approach, okay? I'm basing it on my accounts receivable on the balance sheet. The allowance is on the balance sheet at that amount. It's all based on balance sheet. The income statement, the provision is based upon the sales. They're matched with, at that time, they're matched with the amount that they expect to be uncollected. So as part of revenue recognition, you recognize only the sales that you expect to have transactions transpired in. Okay, so under the income statement approach, we start to make these estimates here, and maybe this amount builds up to more than what you want it to build up to. A lot of companies will use the income statement approach and base it on the sales during the year, and at the year end, they take a review and they say, well, how much do we actually have in accounts receivable? Maybe I want to use the aging method at the year end and calculate what the allowance account should be at year end using an aged accounts receivable, or a combination of both. So companies have the leeway to be able to do these estimates and to go from interim periods using an income statement approach to a year end approach using a more exact amount. So it's perfectly permissible for your estimates. Okay, this has been current estimates of credit losses for accounts receivable, balance sheet, and income statement approaches. And we're looking at the differentiation between the two different ways of posting to the allowance account. This is Professor Campbell. Thank you very much.